Welcome to this course, Risk Analysis, Risk Measurement and Risk Management in Practice. My name is Tumisan Chirisa. I am a Chartered Management Accountant carrying the designation ACMA, CGMA, and I'm a Senior Accountant at Troy Financial Services. I will be taking you through this course and I hope you will enjoy it. In this course, we will talk about risk management, and everything to do with how to mitigate risks in the actual work environment. Topic 1, we will talk about introduction to risk, where we introduce you to the various types of risks and how to identify risks in an organization. Topic 2, identifying, measuring and assessing risks. Topic 3, we will talk about how to manage risks under risk management. Let's move on to look at our topic 1, introduction to risk. Here we are going to introduce you to risk, and we will start by defining what risk is all about. So there are many ways or many different ways of defining risks, which include that risk is a condition in which there exists a quantifiable dispersion in the possible outcomes from any activity. It can also be that a risk can be defined as the combination of the probability of an event and its consequences. Others also define risk as in the chance that the future events or results may not be as expected. So here we talk about the future outcome being diverse or being different from what we were expecting. And businesses, when they make their decisions, when they follow their strategies, they have to take risks, and some risks are huge, some risks are small, and without taking risks, businesses will not thrive, businesses will not grow. So this topic is quite an important topic because it is at the center of how businesses are run. Risk is often thought of as purely bad. So in most cases, people think of risk as a bad side of things happening in a business, but this is not what risk is all about. It is both sides. So it can be pure risk, which we call downside risk, or it can be speculative or upside risk, which means things can actually turn out to be good than what we expected. It is still a risk. But in most cases, what we are trying to mitigate or to control is the downside risk, because that's what can stop the organization from achieving its objectives. In order to assess and measure the risks that an organization faces, a business must be able to identify the principal sources of risks that it faces in an organization, or its environment, or in its industry. Risks facing an organization are those that affect the achievement of its overall objectives, which should be reflected in its strategic aims. So when a business when it put its aims, its objectives, and its strategic goals, we need to be able to identify the risks that are aligned with those goals and see how we can mitigate them or we can control them. Risks should be managed, and there should be strategies for dealing with risks, especially in nowadays. Most businesses actually have a risk strategy in which they detail the strategy that they will do in overcoming risks that they face, that the company faces. And this is quite important because in previous years or in previous decades, this was not the case. Risks was actually a risk strategy, and everything was actually assigned to different managers who will assess and what risks affect their areas, and they develop plan to reduce them. So now it is now taken at board level and at top level as something that is very important in managing organizations. So why should companies incur risk? So it is for two things. First of all, it is to gain competitive advantage. So sometimes you have to take a risk because you are aiming at taking maybe a market or to take over a niche, something like that. So it is always about gaining a competitive advantage, obviously, over competitors. The other one is to increase financial return. So most of the time when a company or even a person, when they take risks, they are intending to increase a financial return now or in the future. So it is the same for companies, it is the same for people. It is generally the case that firms must be willing to take higher risks if they want to achieve higher returns. To generate higher returns, a business may have to take more risks in order to be competitive. Because if you don't take risks, it means you will lag behind your competitors, or you will be following a leader in the industry, which is detrimental sometimes to companies. Conversely, not accepting risks tends to make a business less dynamic, as I said, and implies a follow the leader strategy. Incurring risks also implies that the returns from different activities will be higher. That's what we assume, that when we take risks, we expect to have higher returns in the future, being the return, obviously, for accepting the risks that you'll be taking. And the benefits can be financial, which means we can actually quantify what we have gained from the risks that we took. Or they can be intangible. That means it can be better quality information, it can be better services from our educated employee base. In both cases, this will lead to the business being able to gain a competitive advantage, whether it's a financial benefit or it's a qualitative benefit. Both will result in the business gaining a competitive advantage over its competitors. Now, nowadays we have sort of a model that companies can use to manage risks, which we call a risk management cycle. This one will start by looking at a business strategy, which means we're looking at the goals, the aims, the strategies of a business and what they aim to achieve, and what strategy they have to achieve those goals. And we will look at the risk management group and set goals. So we will look at, okay, what is the risks that this company may face because of its strategy? And then we try to identify risk areas according to the business strategy. After identifying those risk areas, we have to understand and assess the scale of each risk, as in how much impact will it cause if it happens, how much cost will it cause the company to lose if it happens, and then we will have to scale these risks according to their impact. And then we will know that the management will know which risks to focus on and which one to avoid, which one to accept, and which one to reduce. So that's why it is important to have a risk management cycle. After understanding and assessing the scale of risks, it is important to develop a risk response strategy. We have identified the risks, we have understood the impact after assessing the scale of each risk. Now it is important to develop our response to these risks that we have identified, which we call a risk response strategy. All of this actually is centered on the information that we get to actually come to decision making. So information that we get from our research, from our industry, from our competitors and everything, which we will use to develop this cycle. Now, after development of a risk response strategy, it is important to implement that strategy and allocate responsibilities, obviously according to the hierarchy of the company or the structure of the company. We will have to allocate those risks to responsible people within the company. It can be the management, this finance director, human resource director and stuff, depending on the risks that we have identified. After that, we have to look at the implementation and see whether the implementation was fine, and monitoring of controls. So obviously when we implement a strategy, you have to put controls to make sure that what you are trying to achieve is going to be monitored and is going to be assessed as in whether it has been achieved or not. So it is important to implement and monitor those controls. After this, we will take some few times, maybe a year or so, and we will review and refine the process. If it's not achieving the goals that we wanted, we will have to do it again in a better way. This is the risk management cycle, and it is very important and is ever continuing because it has to be refined all the time, because new risks will always continue coming and they need to be dealt with if the organization is to achieve its goals. Now, we need to be able to identify and categorize risks. So many organizations categorize risks into different types of risks. The use of risk categories can help with the process of risk identification and assessment, because you need to know what kind of risk you are dealing with and how best we can deal with it. So there are various ways we can categorize. There's no formula for categorizing risks, but there are set standards that can be used as a template for identifying risks. There is no single system of risk categories, as I said. The risk categories used by companies and other organizations differ according to circumstances and according to the industry and according to the size and nature of the business. So, but in general, we have these kind of risk categories which companies can use. We have got the political, legal and regulatory risks. We've got business risks, we've got economic risks, financial risks, technology risks, environmental risks, corporate reputation risks, fraud and employee malfeasance risk, and international risk. So these are just some, but in most cases, most companies will be within these brackets, and according to what the companies are doing, it will be important for them to identify the risks that are most suitable for their organizations and for their environments. So we will look into these risks, and you can use this as a basis for categorizing risks in your own organizations or in the organizations that you work for. So the first one is what we call the political, legal, and regulatory risks. So in most cases, every other company operates in a country which have got laws and regulations, or in an industry which have got laws and regulations and compliance requirements. Now, the risks, according to this first risk category, is that sometimes the business may be operating in an environment that have got an unstable political leadership, or it can be through regulatory requirements that are very stringent and might cause disruptions to the business operations because of changes in those regulations. Or it can be a legal or a legislation that has been passed that can cause or can stop companies' operations, causing huge losses to organizations. It can be any other of those. So, for example, we're going to talk about these are the risks that businesses face because of the regulatory regime that they operate in. Like I said, some businesses may be subject to very strict regulations. For example, all companies are subjected to the risk of employment legislation changing or customers taking legal action. Companies have to be able to protect themselves, and according to the nature of the company's products or maybe the services that they give, it is important to already plan about the likelihood of these kind of risks and to be able to mitigate and to devise plans or strategies that will help to reduce this risk. So, as we said, we have political risk, legal litigation or regulatory risks, as I explained. We have the second one called business risk. So business risks is the risk business face owing to the nature of their operations and products that they produce or they sell. Some businesses, for instance, are reliant on a single product which means if anything happens to their line of business, or if the product suddenly becomes irrelevant in the market, it means that business can go into liquidation. Or they could be reliant on a small key group of staff, and this staff may be this staff may be quite highly intellectual, and losing any of these will means the business will go out of business. So these risks can be considered in different categories. They all fall under business risks. It can be strategic risk, which means the risk that business strategies that the company is implementing will fail after investing so much, and then those strategies fail. It's a strategic risk. We've got the product risk, which means the risk of failure of the new products that we are trying to launch, or that customers will start losing interest in our products, causing the business to go out of the market. We've got commodity price risk, which means prices of commodities or raw materials going up, which will make it impossible for us to produce. Product reputation risk, the risk of changing product reputation or image. Just people thinking that this product is not, or it's because of technological advancements, which can cause people to change their perception of our products. It can be operational risk. Risk that businesses' operations may be inefficient, or that our business processes may fail. Then we've got what we call contractual inadequacy risk, which means that our contracts do not fully cover our business against all potential outcomes. So some may find loopholes in our contracts and use that against the business, which may cause the business to fail. We've got fraud and employee malfeasance, which we'll look at a later stage, but this is behavior done by employees to evade and to evade controls in the business, to steal from the business and to commit fraud, or to put the image of the company in an unbearable place, which will cause financial loss to the company. These are all the categories that are under business risk, and it is very important because this is one of the major risks that a company can face. But the economic risk, which can be changes to the business because of what is happening in the economy in terms of interest rates, inflation, unemployment rates, international trade relations, fiscal policies, and decisions by government. So this is an external risk, but it's got a huge impact to the business. We've got financial risks, which can be things like credit risk, people not paying, or our customers not paying what they owe our business. So financial risk is a major risk that affects businesses. Financial risk is the risk of a change in a financial condition, such as an exchange rate, interest rate, credit rating of a customer, or price of a good. It includes, like we said, credit risk. It also have a political risk side of it, because of the actions that can be taken by management. It can be currency risk, which is very important for international businesses, or even not, because what happens with the currency affects whether you are directly exporting or importing, or you are not. This will have an effect to the business either way. So this is the risk of fluctuations in the exchange rates. And then interest rate risk, which is the risk of fluctuating in the interest rates. This will have an effect to organizations, especially if you have borrowed funds or capital, loans and stuff like that. So this will have a serious effect to some organizations. We have got gearing risk, which is mostly related to the interest risk because of borrowing, depending on the profile of the company's capital. If it is mostly financed through debt, the gearing risk will be high. So this is quite a serious risk, because In the case that a company wants to get more funding, more financing, it will be considered a risky business, because nobody would want to take care or to give more capital, because they are seeing it as a risky business. Nowadays, we've got this emergence of the technology development, technology advancement, and through it, we've got cyber risks. These are important things nowadays, because most business will thrive, or their existence is based also on technology. So technology risk is the risk that technology changes will occur that either present new opportunities to businesses, or on the downward side, make their existing processes obsolete or inefficient. We have seen business that have gone out of the market, out of the business altogether because of technology. Or we have seen new business that have come all together quickly because of technology. Good examples will be Uber. This is a new way of e-hailing services that have come because of technology advancements and internet services, stuff like that. So because of that, we've got cyber risks. Cyber risks is a focus area for organizations now. It is the risk of financial loss, disruption, or damage to an organization caused by issues with the information technology systems they use. So it can be loss of our information, our clients' database, a loss to our passwords, loss to everything, and that will cause the business to lose financially and qualitatively as well. Now, this is a very serious issue nowadays. We've got environmental risk, which is the risk that arises from changes in the environment, such as climate change and natural disasters. Because of it, some businesses may perceive this risk to be low, but for others, for example, in the mining or insurance companies, it can be more significant. Insurance companies have to take environmental risks to account when deciding, for example, policy premiums, and unusual environmental circumstances can severely alter the results of insurance businesses. We've got fraud, which is more connected to employee behavior. It's a type of operational business risk as well. It is the vulnerability of an organization to fraud. So we are trying to assess that. Some businesses are more vulnerable than others to fraud. As a result, they have to have stronger controls over it. Fraud risk is a risk that is considered controllable by most businesses, and we need also to teach employees that controlling fraud can start from the top. We have what we call corporate reputation risk. It's one of the most important, and reputational risk can actually throw a business out of the market, out of operation, because people have decided to turn their back out of it after maybe a scandal or something like that. Reputation risk is, for many organizations, a downside risk. Is the better the reputation of the business, the more there is of losing that reputation. So if a company has a good reputation, usually it is actually more risk to them. They consider more risk that if they lose that reputation, they may go into oblivion. Because when there's a good reputation, because of competition and everything, there will be more ways of other competitors trying to paint or trying to find where the business is not doing fine. A good reputation can be very quickly eroded if companies suffer adverse media comments or are perceived to be untrustworthy, or nowadays when they are considered to be not environmentally conscious. This could arise from their environmental performance and initiatives, social performance and social initiatives, health and safety performances. That is just their overall outlook and how they take care of their employees, the community, and the environment. That's all that can actually erode a company's good reputation. Malfeasance means doing wrong or committing an offense. So this is under employee malfeasance risk. Organizations might be exposed to risks of actions by employees that result in an offense or crime other than fraud. This, like fraud risk, is a type of operational business risk. Examples of employee malfeasance are deliberately making false representations about a product or service in order to win a customer or to win a customer order, exposing the organization to the risk of compensation claims for mis-selling or misrepresentation. The employee may be doing it thinking they're doing it in the right way or in a good note to entice a customer to buy. But actually, if there is a case or there is maybe a problem with the product, this will result in the company losing so much. So it is important for companies to actually advise and tell and teach their employees on how to carry themselves. It can be committing a criminal offense by failing to comply with statutory requirements, such as taking proper measures for safety and protection of employees or customers. So in most cases, in most countries, there are health and safety regulations, and depending on the environment in which the company is, they would have to abide fully or partially to those requirements. Risks from illegal activities by employees should be controlled by suitable internal controls to ensure that employees comply with established policies and procedures. Risks in internal operations, we've got what we call international risks. The national businesses are subject to all the risks above, but also have to consider extra risk factors which could be due to the following. So, for example, an international company could face risk associated to culture. For example, a UK business may fail in a venture overseas because it does not adapt to the overseas culture or to the country that they are trying to get into. They have to adapt to the culture there. Good knowledge of local culture, local histories, local lingo, and everything can give companies an advantage. So it can also be litigation risk. Because of litigation, there is a greater litigation risk in overseas operations, as the parent company management may not understand the legislation in the company they are intending to operate in, and are therefore more at risk of breaching laws in that country. It can be credit, because they are dealing with new clients overseas, and some may never pay, and it will be very difficult to chase debts in a new environment. It can be in terms of transit. Maybe it's a company that produces goods overseas, and they would have to take their goods all the way across to the new environment that they are trying to operate in, and that means more costs in terms of losses through the seas, more insurance costs, trying to insure in terms of if there is any losses along the way. It can be financial risks, which include foreign exchange risks now, because they are trying to engage in foreign grounds. So, and also interest rate risk. Now we move to topic 2, identifying, measuring, and assessing risks. So after identifying all these risks that we have been talking about, and these are not exclusive, because depending with the company, some may have other risks that can be included in those categories. So they are not exclusive, they are just the most general categories of risks that a company could find. So the first thing we're going to talk about under topic 2 is how to identify risks or risk identification. It is key, however, that businesses can identify the risks they face and evaluate the effect of these risks on the business. Some risks will be relatively easily borne by the businesses, but others will be more difficult and more serious. As mentioned in the previous topic 1, risk identification is very important. So through all those categories, risk identification process will often be controlled by a risk committee in most companies. But if some companies do not have this, it may be just a risk manager or a risk management specialist, or it can be through the internal audit department. So there is always a certain group or a person that will be responsible for identifying and controlling risks in an organization. Risks identified in the process should be recorded in a risk register. So we have a group of people, maybe the internal auditing, maybe the audit, the audit committee, or it can be the risk specialist or the risk committee. Whoever is mandated to dealing with risks, we have to identify the risks that are prevalent in that organization. And the best way to identify them is through what we call a risk register, which is mostly in a tabular form. It is simply a list of risks that have been identified and measured, that have been taken. We're going to take measures, obviously, to control them, and we write them all in that risk register. There are a variety of methods that can be used by businesses to identify the risks they face. The risk register is a very important and practical risk management tool that should be used by all companies. It takes several days, if not weeks, depending obviously on the size of the company, to produce, and needs to be reviewed and updated regularly because risks are always coming, new risks are always emerging, and we need to add them and review them and mitigate, measure them. Often annually, it depends with the company, in conjunction with corporate governance guidelines. So in most cases, in most areas, there are corporate governance guidelines. Some are principle-based, some are compliance-based. For example, in South Africa, we have what we call the King 3 Code of Corporate Governance, which requires that companies abide by its regulations on a principle-based. But in the US, you have corporate governance guidelines there, which require to be compliant. Companies to be compliant with. Otherwise, if you're not compliant, and then it can be an action that can be taken, you can be brought to court, and it can be something that can cause managers to even go to jail. So that's how it is. The risk register is often laid out in the form of a tabular document, as I said, with various headings. Most notable headings of a register include the risk title. So we are stating what risk it is that the company is facing, or we have identified that this company is facing this risk. So you have to state it. If it's a financial risk of exchange rates fluctuating, then that's the title of that risk. Secondly, it can be, we want to know about the likelihood of this risk. So the likelihood of the risk possibly may be measured numerically, depending, you can put it on a scale from 1 to 10 or 1 to 5, with 1 being unlikely to happen and maybe 10 or 5 being highly likely to happen. So the scale will depict how the company is taking that risk. Is it too severe to the company, or is it less severe? The impact of the risk should it arise, we want to know what, if it happens, what will be the impact? Does it make the business to close altogether, or it is just a small impact that we can just we can continue running and we can just deal with? We need to know the risk owner of that identified risk. We need to know who is responsible for managing it. Usually it's a manager given the responsibility, or a director or a supervisor. We need to know the date that risk was identified, which should be detailed in the risk register. The date the risk was last considered. If actions have been taken and it has been reduced to be of no impact, we need to know the last date it was assessed, and we should be taken. It should be written down that this risk is considered to be irrelevant now from this day, because we've done 1, 2, 3. 7. Mitigation actions should be listed. Obviously, we need to know what have you done to mitigate or to reduce this risk. So it's important. Did you do training? Did you take an insurance? All those things that we've done to reduce that risk. An overall risk rating might be given so that management can immediately see which risks are the ones they should be concentrating on. So giving a rating maybe of 10 to say this risk is highly regarded and management needs to focus on it, or 5 to say yes, it is there and you still need your attention, but it's not as that, or 1 to say this is a low risk, and you can look at it when you have done, or others. This is not an important, it won't cause any major harm to the organization's operations. We need to also know further actions to be taken in the future. If there is any action that needs to be done, we need to know what will be done in the future if it arises and stuff like that. The action lead name will be detailed. Who is responsible for making sure that these future actions are implemented? So who will conduct, if let's say it happens in future, who will be responsible for it? Is this the manager or it is somebody else? A due date will state the date by which action has to be implemented. We need to know a risk level target, which can be a score, maybe just like what we are saying, 1 to 5 or 1 to 10. This might mean that by implementing a control, the risk rating is implemented to lower from, say, maybe 8 to 2. So we are saying, well, after the action that we have taken to reduce this risk, we think that it is reduced from being a 10, which was high impact, high risk, to being now a 2, which is ignorable risk, something like that. Now, we've got common methods that are used to identify risk. Remember, we talked about risk identification, and we are talking about identifying all those political, blah, 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 all those risks. We have got ways, or most used ways, to identify those risks. So we have got those risks that are internal and those that are external, and we've got ways that we can use to identify whether internal or external risks. So it can be in a reactive way or in a proactive way. Reactive maybe means by reacting to something, you're identifying more risks, or identifying the risks, or by thinking ahead according to the strategy and objectives and aims of the company, we can think of the risks that the company will face. So let's look at reactive, how we get these risks through reactive ways internally. So it can be through internal audit inspections by our internal audit department. It can be through complaints and incidents and claims in the company, and we know that I think there is a risk here that we need to control, and we need to take it down, this risk. Or externally, it can be through customer surveys that we do as a company. It can be through external auditor reports, which will tell us, we have got risks in your internal controls and blah, blah, blah. And then we've got professional bodies recommendations. We've got health and safety reports. There may be the health and safety regulators. And proactively, internally, we can also do what we call brainstorming to identify the risks that the company is faced internally. It can be through pest or SWOT analysis. It can be through our strategic objectives to identify our risks there, because we know what we want to achieve and we know the risks that can be faced. It can be through staff interviews and questionnaires by asking our employees maybe what risks they are facing. We can do also scenario planning, and externally we can have external advisors advising us about the risks that is in our business. Consultations with our shareholders, mandatory statutory targets, or benchmarking. These are all methods that we can use to get to identify the risks that are there in our business. Now, after identifying the risk, it is not important only to identify the risk, and then we need to quantify the risk so that we will know the impact that that risk has on the business and its operations. So quantification of risk is important in understanding the extent and significance of risk exposure that we have to that risk. This can be done by measuring the impact of the risk factor, such as, for example, exchange rates, on the total value of the company. So what loss would the exchange rates cause, maybe to the revenue of the company, and we need to quantify it. Or in individual items such as cash flow or costs, we need to know what would the risk change in exchange rate cause to the total revenue of the company, or to the costs, or to the cash flow. All those things we need to quantify it. Risks that are identified should be measured and assessed. The extent to which this can be done depends on the information available to the risk manager. In some companies, particularly in the banking and insurance industries, many risks can be measured statistically on the basis of historical information. In many other institutions, the measurement and assessment of risk depends on management judgment. But some of the most quantitative techniques include what we call expected values and standard deviation, which we will look at, okay, what were we expecting to achieve, and how much have we deviated from that with our actual figure? How much did it deviate from the expected value or the expected figure? We have what we call volatility. We look at volatility. How volatile is the situation? How volatile are the exchange rates changing in a month, or in 2 months, or in a year? And we can use that to quantify. We have what we call value at risk, which is a calculation that is done mostly in the banks. Regression analysis, simulation analysis, and among others. We have what we call a risk mapping or risk assurance mapping. So some say risk mapping, some say assurance mapping, whatever way it is the same. It is a common qualitative way of assessing significance of risk. So to produce a risk map, or sometimes called an assurance map. So we just want to assess the significance of the risk. So we can map the risks as in this category of risk is serious, highly likely with great impact, or low likely, great impact, or low likely, low impact, or all those things. So the board or the risk committee and the audit committee and senior management from various departments, we will all be involved in the preparation of this map. But it is important to know which risks we need to focus on, which ones are likely and which ones are not likely. The map identifies whether a risk will have significant impact on the organization and links that into the likelihood of the risk occurring. The approach can provide a framework for prioritizing risks in the business. Risks with a significant impact and a high likelihood of occurrence need more urgent attention, obviously, and management have to put more attention there and focus there than the risks with a low impact and low likelihood of occurrence. A well-structured risk map will highlight where there are gaps in assurance over significant risk areas. Also, duplicated or potentially burdensome assurance processes may be identified. Risks can be plotted on a diagram as shown below. So you just have to look at, okay, impact and consequences there. Impact or consequence, you group it as whether it's low impact or high impact. And you have on the other side, is on the diagram there, probability or likelihood of it happening. Is it low probability or high probability? So we have high probability, low probability, or high impact, low impact. So you going to put your risks into this map. If you group the risks as high probability and a high impact, it will be very much better for the business to avoid such risks, because they are high probability and a high impact. If there is a way to avoid them, let's just avoid them. If there is a high probability and low impact, we can just reduce them then, because there's low impact, although they can happen every time, but there's low impact. They cannot stop us from doing our business. So let's try to find out how to reduce them. Or if there is a low probability and a high impact, then let's transfer them to another third party. That's where insurance companies come in. Those organizations will just transfer their risks. If they have a low chance of them happening, but when they happen, they have a high impact, then we transfer them to insurance companies. Then also, if there is a low impact and low probability of them happening, then we just accept them as they are, because they're not going to happen likely, but when they happen, they have a low impact, so there's no need to worry about them that much. So the risk map immediately indicates which risks should be given the highest priority and which ones to be given the lowest priority. So that's all we're explaining here on the following slides here. So for each high probability, high risk impact, we need to do further analysis with the view to estimating the probability of an adverse or favorable outcome more accurately. So either we need to say, is there going to be an adverse? We need to be very accurate on estimating and quantifying it. As in, this will cause this amount of loss. We need to assess the impact on the organization of an adverse outcome. This is an area in which accountants or risk specialists should be able to contribute by providing suitable and relevant financial information. Another alternative layout for a risk map would be a tabular format. The risk map is best in terms of quantifying the risk, but there is other ways. The tabular format, which is more like a risk register, which the table might have the following columns, like the risk name, the likelihood of that risk arising, which is whether it's low, medium, and high, the impact of the risk if it does arise, the controls that are already in place, who is the risk owner, and the name of the director or manager who will watch out for this risk when it arises, whether assurance is sufficient. This might be given a score out of 10, controls to be implemented in the future, and so forth. So, but the risk mapping is always one of the most used. Risk management, topic 3. So after all these, we need to be able to manage all these risks, obviously putting them under control. The process of understanding and managing the risks that the organization is inevitably subjected to in attempting to achieve its corporate objectives. Traditional view of risk management has been one of protecting the organization from loss through conformance procedures and hedging techniques. This is about avoiding the downside. The new approach to risk management is about taking advantage of the opportunities to increase overall returns within a business benefiting from the upside risk. Risk management can reconcile the two perspectives of conformance and performance. Nowadays, we have what we call enterprise risk management, which is trying to control risk and embedding it in the risk or in the business strategy of the company. So we need to start thinking of the risks already when establishing the business strategy. So that's the tech nowadays. So enterprise risk management is the term given to the alignment of risk management with business strategy and the embedding of a risk management culture into the business operations, starting from the top to the last employee. It has been defined as a process effected by an entity's board of directors, management, and other personnel applied in strategy setting and across the enterprise, designed to identify potential events that may affect the entity and manage risks to be within its risk appetite, to provide reasonable assurance regarding the achievement of entity objectives, according to the COSO, Committee of Sponsoring Organizations of the Tradeway Commission. So that's the definition of enterprise risk management. It simply means including risk strategy when developing the business strategy of the business of the whole company. So right from the start, we need to take into consideration the risks that will be faced. Risk management has transformed from a department-focused approach to a holistic, coordinated, and integrated process which manages risk throughout the organization and everybody involved. Key principles of ERM include consideration of risk management in the context of business strategy. Risk management is everyone's responsibility, with the tone set from the top. The creation of a risk-aware culture, a comprehensive and holistic approach to risk management, consideration of a broad range of risks. So we got strategic, financial, operational, like those ones we identified already. A focused risk management strategy led by the board, embedding risks within an organization's culture. So we've got what we call the double helix, which depicts this. So right from developing our mission, vision, and core values, we need to look at the governance and culture and the risks involved in that, and start developing the strategy, our objectives. We look at with the risks for each and every objective that we are setting, and we're already embedding the risk there. Business objective formulation, performance and risks associated with that, implementation on performance, review and revision, and that. So it is all about embedding risks throughout our development of our strategy. Remember, this is the development of strategy that we have. So we are embedding risks right from there. So the double helix is broken down into 5 components, which is governance and culture. This relates to the internal environment and emphasizes the importance of the tone of the organization. It also includes ethical behavior and understanding the risk appetite of the entity. Strategy and objective setting, which is the second one. This component is possibly the main focus to the update, to this helix. It emphasizes the importance of making sure that enterprise resource management and objective setting is aligned to risk appetite in the strategy planning stage to make sure that the strategy can be implemented successfully. This component therefore helps to minimize the risk of the wrong strategy being chosen. We also have performance. This combines the components from the original cube of event identification, a risk assessment, and risk response. It involves maintaining a focus on identifying internal and external events, both positive and negative, which could impact upon the achievement of an entity's objectives, assessing the likelihood and the impact of these events to prioritize their importance, and then developing a response to accept, reduce, avoid, or share the risk. So we have got the fourth one, which is review and revision. Policies and procedures to help ensure the risk response are effectively carried out through the selection of key metrics. This ensures that the entire ERM process is monitored and modifications made as necessary. The last one, information, communication, and reporting. As always, it is vitally important that the relevant information is identified, captured, and communicated in a form and time frame that enables people to carry out their responsibilities, and that this information is reported to the right people and levels, be that directors or shareholders or top management. So enterprise risk management is very important because it enhances decision making, obviously by integrating the risks right from the start. It reduces performance fluctuations and fewer interruptions to operations will be achieved. The resultant improvement in investor confidence and hence shareholders value. Focus of management attention on the most significant risks. A common language of risk management which is understood throughout the organization, enabling performance improvement. It also can cause increased ability to benefit from upside risks and reduced susceptibility to downside risks. Reduced cost of finance through effective management of risks, improved utilization of resources, increased opportunities for the organization. Formulation of a risk strategy. As we said, so it has to be embedded. We need to formulate a risk strategy. So for many businesses, the specific formulation of a risk strategy has been a recent development, because it was never happening. It was never happening in the previous days or previous years, as risk was just risks management was just an additional responsibility for managers. So each manager will be given an additional responsibility to identify and manage. It was not a holistic approach throughout the organization. It was a formal strategy for managing risks. Now it is a formal strategy that is being adopted throughout the organization. So that's how it was. So failure to properly identify and control risks has been identified as a major cause of business failure. Remember the Barings Bank, remember Enron and other notable big companies that have fallen in the past. So because of those situations, it has become a very important aspect to formulate a risk strategy. So a risk management strategy needs to be developed to ensure that the risk exposures of the organization are consistent with its risk appetite. At the very least, the risk management capability within the organization should be sufficient to review its internal control system and its adequacy at least annually. So we need to sit at least annually and review. We need to ensure that controls are properly implemented and monitor the implementation and effectiveness of those controls that we have implemented. We need to see if they are working and they are really reducing whatever risks that we have found. However, the investment by the organization in risk strategy should be largely determined by the performance requirements of its business objectives and strategy. A risk appetite can be defined as the amount of risk an organization is willing to accept in pursuit of value or in pursuit of its objectives. This may be explicit in strategy, policies, and procedures, or it may be implicit, and it is determined by the risk capacity. That is the amount of risk that the organization can bear, and the risk attitude, which means the overall approach to risk, the overall approach that the company has to risk, in terms of the board being risk averse or risk seeking. Risk averse means not willing to take more risk. We just want limited risk or no risk at all. Or risk seeking, in which the company is eager to take more risks and follow risky projects. The way that the organization documents and determines the specific parts of its risk strategy should be linked to the business strategy and objectives. Overall, risk management strategies is concerned with trying to achieve the required business objectives with the lowest possible change of failure. The tougher the business objectives, however, the more risks will have to be taken to achieve them. A residual risk, which is important here, is the risk a business faces or the risk that is left after the business has implemented all its risk mitigation strategies. There's always a risk that is, so we need to see, that is what we call a residual risk. We need to see what risk is still there after we have implemented all our risk management strategies. That kind of risk is what we call residual risk. You need to see if it's still high or it is something that we can ignore as a business. Key features of a risk management strategy are as follows. we need a statement of the organization's attitude to risk. So this is set at the top. From the top management, they need to put out a statement for the whole organization about what the attitude or to risk of that organization is. We need to have the balance between risk and the need to achieve our objectives. So we need to balance these two, the amount of risk that the business can take, which can and obviously which can aid to achieving our objectives, and not put the organization under too risky situations that will put it maybe to serious financial losses and stuff. We also need to know the risk appetite of the organization. Is it a risk-seeking organization, a risk-averse organization, or not? So usually this is found obviously in the board or the top management of the company. We can see from their behavior whether the company is a risk seeking or risk averse. The objectives of the risk management strategy. What are we trying to achieve with this strategy? Which risks are we trying to reduce or to eliminate? Culture of the organization in relation to risk and the behavior the organization expects from individuals with regards to risk taking. Responsibilities of managers for the application of risk management strategies. Reference should be made to the risk management systems the company uses, i.e., for example, its internal control systems. Performance criteria should be defined so that the effectiveness of these risk management strategies can be evaluated. Now, after identifying all these risks, we need to be able to treat them or to manage them or to mitigate them. Now, as we spoke earlier, we talked about avoiding risk if it is too high likelihood and high impact, we can avoid. So that's the first thing, we can avoid risk. A company may decide that the company's activities are so risky that they should be avoided. This will always work, but it is impossible to apply to all risks in commercial organizations, as risks have to be taken to make more profits or returns. We can also transfer risks, like in the cases of insurance, as we spoke earlier, by transferring to a third party. So it is out of our way and we have transferred it. If it happens, a third party loses. That's the insurance thing. But the only downside of it is we will pay even during the time when there is no exposure to that risk. So we have to pay premiums and stuff like that. So we lose in some other areas. Pool the risk. So it means risks from many different transactions can be put together. Each individual transaction or item has its potential upside or downside risk. So when you pull them together with their upside and downside, the risks will cancel each other, and we will be left with either a minor downside or a minor upside risk. The risk tends to cancel each other, as I said, and are lower for the pool as a whole than for each item individually. For example, in large companies that have got maybe offices across the world, we can pool financial risks or exchange rate risks together and manage them centrally. So we look at which area is eliminating the other risks up, and we are left with one single risk. Diversification is a similar concept to pooling, but usually relates to different industries or countries. Just like the old adage that says, do not put your eggs into one basket. The idea is that the risk in one area can be reduced by investing in another area where the risks are different or ideally opposite. So if one fails, the other one will help the other. Risk reduction means even in a company cannot totally eliminate its risks. It may reduce them to a more acceptable level by a form of internal control. So we need to reduce those risks by putting controls. The internal control would reduce either the likelihood of an adverse outcome occurring or the size of a potential loss. The costs of the control measures should justify the benefits from the reduced risk. Hedging risks is another. We can hedge them. The concept of hedging is reducing risk by entering into transactions with opposite risk profiles to deliberately reduce the overall risks in a business operation or transaction. Or we can share the risk. We can share by sharing the risk with another party. This can be a motivation for entering into joint venture, joint operations, and stuff like that. We want to share the risks that we can be exposed to. Another simple way of these risk management tools is what we call the TARA method. So we can use the mnemonic TARA, TARA, which represents transference, which means transferring the risk to a third party, which in this case can be the insurance companies, like we explained. We talked about avoidance, which is the same, avoiding the risk. If there is too much risk, you avoid it and not take part into such a risky maybe decision that the company was opting to follow. Reduction or mitigation, as we spoke, a third strategy is to reduce the risk, either by limiting exposure in a particular area or attempting to decrease the adverse effects should that risk actually crystallize or happen. Then last one is acceptance. If there's low impact, low likelihood, we can just accept it. So the final strategy is to simply accept that the risk may occur and decide to deal with the consequences in that particular situation. The strategy is appropriate normally where the adverse effect is minimal. So for example, there is nearly always a risk of rain unless the business activity cannot take place when it rains. Then the risk of rain occurring is not normally insured against both. It is it has no major impact, and no major likelihood as well, unless if it's dust season. So risk reporting also is very important nowadays. We need to report risks. And in some countries, it has become part of financial reporting requirements. For example, in the UK, in annual reports, there should be a section talking about the risks. It is an important disclosure requirement. Managers of a business and external stakeholders will require information regarding the risks facing the business, and a risk reporting system should include: 1. A systematic review of the risk forecast, at least annually. This needs to be done. A review of the risk strategy and responses to significant risks. A monitoring and feedback loop on action taken and assessments of significant risks. A system indicating material change to business circumstances to provide an early warning. And also the incorporation of audit work as part of the monitoring of an information gathering process. Once the company has established its risk strategy and decide in what areas it will reduce its risks and the methods it will use to achieve the desired reductions, the strategy should be evaluated now. The purpose of the evaluation obviously is to find, so it is twofold. That is to find whether the strategy has achieved its objectives, and do the benefits of this risk strategy outweighs the cost. This is the cost-benefit analysis now that we have to look at. Was it even necessary? Now, at the end, we just need to look at the management roles and responsibility with regards to risk. So, who is responsible for what? So, with the board of directors of a company, which has the ultimate responsibility for risk management. It is the one body that will be accountable and responsible for the risks that happens in the business and the mitigation that had happened. So the board also defines the appetite for the organization in terms of risk. We also have the audit committee. The board committee or with responsibilities for reviewing internal control systems and working with internal and external auditors. So that's an audit committee. They have to review these systems in the business to see if they are working correctly, and they also can work with external auditors in that regard. Some companies do have a risk committee, or if a risk committee does not exist, the audit committee usually absorbs this work if there is no risk committee. But the risk committee is a board committee with the direct responsibility for risk management. So if there's a risk committee, it will take all responsibility for, not all responsibility, it will take responsibility on establishing, management, and identifying risks, those things, although the board has the ultimate risk, ultimate responsibility, We've got risk management groups led by the risk manager in some organizations. So it's a group of senior and middle management with operational responsibilities for carrying out the risk management process. They report into the board via the audit or risk committee, and they are also involved in the identification of risks and monitoring the effectiveness of the overall process and make recommendations for improvement. And we also have the internal audit, which is involved in the review of internal controls within the company, support management in the risk management process. Now, these are the roles that are available within normal organizations with regards to risk management. Now, this is the end of our course, and I hope this course will bring you the relevant insights into risk management, and this will aid you in whatever environment you are working in. And thank you for choosing this course.